Joining us now is Guggenheim Partners Investment Management CIO Ann Walsh. Ann was named to Barron's list of 100 most influential women in U.S. finance. Welcome, Ann. It's good to see you.
Oh, thank you, Sarah. It's nice to see you as well.
So talk to us about what you are looking for as far as the economic projections in the dots.
So I think we're going to get a sense of where the Fed believes they need to go at this point in time. We believe that the Fed's probably on hold. Whether they signal that with a bit of a hawkish tone is probably to be expected. They don't want to have to reverse course and start raising rates again, but we don't see that in the projections. I think what will be probably more informational is where they see the future neutral rate to be. And whether they can start lowering rates into 2024. Before we even get to that, I think we're going to see continued slowdown in the economy and lower inflation. And, that's the trajectory. But nothing moves in straight lines. As was just noted, oil prices have been increasing, and that, of course, is going to have an influence on inflation in the short run.
So, Ann, how are you guys positioning at Guggenheim around the soft landing story? Are you gearing up for a more pronounced recession?
So our view is that we will see a slowdown in the economy. Whether it's a full-blown recession or a type of rolling recession or just a significant slowdown, I think that's ahead of us. The Fed has done a tremendous amount of tightening into this and through this cycle, 5.5% Fed funds with quantitative tightening, i.e. the reduction of the balance sheet. That is still ongoing in the background. And so I think conditions continue to be tightened for investors. As a result, we're really thinking about how to position coming through a slowdown. And that means being more defensive, particularly at this point in time. Now, the opportunity set exists very nicely in investment-grade fixed income. You're getting yield, which we weren't getting last year or the year before. And so investors are getting rewarded to be patient and defensive into this cycle, particularly in investment-grade corporates and structured credit, where you can get 5.5%, 6 to 6% yields. Very attractive at this time.
What about the equity market? Anything look attractive there?
Equities are a bit concerning because I think they are overbought at this time. PE ratios were really, PE ratio expansion was really the, multiple expansion was really the driver of performance this year. And that concerns me with regard to the broader markets. As we were just listening in earlier, you were talking about the shift towards defensives. I think the market is moving in that direction, albeit a little bit slowly. And so I think that being thoughtful with regard to positioning at this point in time will hold investors in good stead. I mean, we're seeing even in high yield, though, there's still investment opportunity, but we're going up in credit quality there and being more defensive in terms of covenant protection, investor protections at this point in time. The Fed's really trying to slow the economy down, drive down demand, and ultimately usher in this slowdown of this recession that we're projecting. And so being thoughtful and being defensive at this time makes a lot of sense.